Good morning, everyone, and welcome to Treasury Strategies' State of the Canadian Transaction Banking webinar. We feel it's important to have this brief webinar this morning to talk about key issues that Canadian banks are facing this year. We know that we're under a lot of pressure due to tightening net interest margins and slower loan growth in the Canadian economy, and we'll need to be buttoned down in our strategies in transaction banking. I am Marika Christopher, a principal in the Financial Services Practice at Treasury Strategies, and Dave Robertson, a partner of our Financial Services Practice, joins me. As a quick aside, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording. And should you wish to ask any questions, you can do so in the question box at the bottom right-hand corner of your screen, and we'll handle these questions offline when the message is done.
Thanks, Marika. So we're very happy to be kicking off 2015 with our State of the Canadian Transaction Banking Market. And I think in Canada, we're facing some headwinds. If you think about the crisis, when it hit the U.S., the Canadian banking system was not hit anywhere near as hard. The banks were in much better shape. In fact, the Canadian economy did better. But what we're seeing now is slowing economic growth in Canada. In fact, we just saw some investor analyst reports that were very bearish on the Canadian banks. And if you actually look at the U.S., it has quite a bit of government debt, and consumers in the U.S. have been cleaning up their balance sheets. Meanwhile, in Canada, consumers are pretty much at their limit for debt, and that is slowing the loan growth in the Canadian market. And so I think many of the Canadian banks are really taking a stronger look at efficiency, and they're also turning to the commercial bank and asking the commercial bank, hey, can you help out the retail bank? It's going to have a bit of a tough year. At the same time, we're facing an interest rate reduction by the central bank, and so that's further compressing deposit margins beyond what was already being experienced. So given all of these headwinds, it's imperative that banks in Canada position themselves to address these environmental threats and still produce the growth that the investors and the C-level suite are demanding from the banks. So we're going to address a few things today. One is we want to talk about Basel III. What are the implications and what are the strategic responses that financial service providers in Canada need to be prepared for? The second is we want to talk about the changing competitive space. Canada has long been an oligopoly, which doesn't mean it's not been competitive, but we're certainly seeing more new entrants in the market, both the global banks intensifying their efforts, regional banks entering, and even non-banks being quite active, especially in the cross-border payment space. And then lastly, we want to talk about some specific areas that offer short-term growth for Canadian banks in 2015. So if we look at Basel III, we want to focus on a few things. One, Basel III is going to completely rewrite the economics of deposits. In the past, there was somewhat of a loose arrangement where each bank could assess the liquidity risk and the value of deposits, make a judgment about the value, and price them accordingly. That didn't mean that there were huge disparities in what the banks were doing, but there was a lot more flexibility in managing liquidity risk and making decisions strategically about where to extend liquidity risk to clients and accepting deposits and how to price for that. Basel III is going to force banks to be far more explicit in how they recognize and assess the nature of deposits, how they assess the economic costs, and that's going to focus much greater discipline, not only in pricing deposits, but also in structuring deposit relationships. So that's going to pose a lot of issues for the banks. One is, first of all, just the need to mechanically calculate the implications of Basel III in terms of the liquidity coverage ratio. But secondarily, it's going to be critical that the economics of the deposit relationship are understood, and that's factored into an overall relationship profitability model that allows banks to make very precise pricing and profitability decisions. Once that's done, I think banks are going to take a look at their portfolio, and to large measure, they're going to look at their deposit relationships and be quite happy with them. But there's going to be a set of deposit relationships that in the new post-Basel III environment are simply not going to be profitable. And at that stage, banks are going to be faced with the desire and the need to restructure those relationships, either by cross-selling more fee services, by repricing the deposit, or in some cases, actually exiting the deposit or even the entire relationship or market segment. I think it's also timely to note that we just saw an article where JP Morgan is now exiting and pricing deposit relationships far more aggressively in anticipation of Basel III. The second thing that's going to have to happen is the sales and implementation model are going to have to change. If we think back to the 1980s, bankers had to begin to become much more scientific about credit. They had to assess risk, and they had to structure the credit to make a risk-return trade-off. We're going to see the same thing happening with banks and deposits. Either the relationship manager or the Treasury sales officer, either separately or in concert, are going to have to understand the customer's deposit nature, and they're going to have to make a decision about how to structure and price that deposit, taking into consideration not only Basel III and the leverage ratio, but also the overall value, the tenor, and the stability of that deposit. And that's going to ripple down. The banks are going to have to set much clearer sales incentives and metrics around deposits. Product teams and sales are going to have to work much more closely with corporate treasury, structuring the products, positioning the rates, and making profitability decisions. And at the same time, we're going to see incredible competition for a relatively flat base of fees and deposits. And as a result, banks are going to have to deliver an excellent customer experience. All too often in the Canadian market, there's been challenges with implementation and onboarding of clients, whether it's simply just the process of getting the client into the bank or getting them through KYC, or even in some cases, the need for file integration. We're seeing a need for the banks to be far better at onboarding the client and getting the client into the bank. One thing we're seeing in the Canadian market in particular is a surge in private equity and limited liability corporation structures, and these can be very challenging for banks' know your customer and risk management programs. So that's something that banks are going to have to put a lot more effort into educating their clients and their salespeople and coming up with a streamlined process that makes it easy and accessible for clients. We also believe that we're seeing a shift in the economics in Canada. We're seeing some of the power shift from the commodity-producing regions like Calgary back to some of the more traditional markets like Vancouver and Toronto, and there may be a need to rebalance sales forces in light of those changes. So at this time, I'm going to turn it over to Marika, and she's going to talk about some of the competitive factors.
Thanks, Dave. As you mentioned, Canadian banks are very stable. They've historically been very well capitalized and have faced limited competition to date, which is great, but it also means that the Canadian market is an attractive one for new entrants, both large and small. So we're seeing a couple of kinds of new entrants into the Canadian space. We're seeing some of the largest banks like JP Morgan and Citi crouching in on a traditionally Canadian space, becoming fiercely aggressive for a relatively flat base of fees and deposits as they are exiting some other businesses in the U.S. And what's going to be interesting is that these large banks have a lot more investment money to spend on their platforms, building out new capabilities and maintaining existing solutions that the super regionals in Canada and throughout the U.S., frankly, don't have and aren't able to compete on. And as they are exiting other businesses that they find to not be as profitable due to Basel III and some other regulations, they are going to become extremely aggressive in gathering new deposit and fee relationships in the Canadian market. And as the Canadian market and economy remains relatively flat right now, that means that they're going to be trying to steal share from the historically Canadian banks. We're also seeing some of the smaller regional U.S. banks encroaching from a deposit rate perspective and picking off relationships by using rate propositions, and eventually going on to win larger pieces of the fee business and taking that away from existing Canadian banks.
You know, I think it's interesting, Marika. We're seeing a couple areas where the global banks are leveraging their scale. One is clearly in the commercial card space, where obviously there are still some Canadian banks that are powerhouses in this space, but other Canadian banks have outsourced or partnered in that area, and that's presented an opening for the banks to enter. And then I think we're also seeing that while some of the house headquarter Canadian banks are still being served primarily by the local banks, we now have the situation where if, let's say, a company is headquartered in Europe or the U.S. and they have a division in Canada, the large global banks are starting to pick off that business in particular and make the argument that can be more easily and efficiently delivered through a global banking relationship. In some cases, we're also seeing the global banks do a much better job of selling ERP integration relative to what the Canadian banks are doing. It doesn't mean the Canadian banks don't have the capabilities. It's just that we've seen the global banks a little bit more aggressive in delivering those capabilities to market. So in addition to these competitive threats, we want to talk about some of the opportunities for growth. The first is around globalization. Canada is a far more global economy than people give it credit for, and there's a need to serve those clients. We've done some research in the Canadian market around this, and what we found is that as much of a third of the cross-border payments flow is transacted outside of the primary operating bank. This is particularly interesting in the commercial space, where these mid-sized companies are turning in particular to non-bank providers to execute their global payments. And when you think about that, the question is, why are they doing this? Well, there's really two reasons. One is these non-bank providers make the global payments very simple. They ensure the Canadian corporate that they are going to deliver the exact amount of currency that they want without any deductions to the end state, whether that's a supplier or in the case of a receivable from a customer, actually debiting the correct amount. So this is something that, in the end, the customer may be getting a worse deal because there's more spread being picked up, but it's meeting their need for a simple execution with a certainty of the notional value. The second thing we're seeing is that these non-bank providers are very aggressive from a sales standpoint, and in many cases we're seeing that the primary sales force covering the commercial market is just not sufficiently clued into the global needs of the client. They're not aware of it, or they're not taking the time to data mine, uncover those needs, and sell cross-border payment solutions to the client. The second area for growth is scope expansion. And by scope expansion, I don't mean delivering whole new products, but I think there is an opportunity to deliver more services into the market. A great example of this is remote deposit capture, which is now available in the Canadian market. Moreover, though, we think it's not just a matter of selling remote deposit capture, but it's taking an integrated receivables approach and selling a more holistic solution. So talking to the client about the various channels for collecting from customers, the best way to gather information for posting, and the best way to adjudicate any exceptions and disputes. Secondarily, I think there's an opportunity within the Canadian market to sell additional services, whether that's value-added services such as positive pay and fraud protection, or whether it's information. Really the key to this is unlocking the sale of these value-added solutions through a more advisory, consultative sales approach. And lastly, there's clearly an opportunity to sell more services down market. There are just, tons of companies in Canada that are 5 to 20 million in revenue that can benefit from some of the very sophisticated services that Canadian banks can offer. However, these services need to be simplified, their value propositions need to be far clearer, and they need to be sold aggressively. And again, remote deposit capture is a great example of a product that at a base offering of, let's say, $125 a month doesn't make sense for a small customer, but could make sense as a 2-year contract and $25 a month, for example, to be cross-sold heavily into that base. So while there are significant headwinds, there's also great opportunities for growth, capturing more cross-border payments and the associated FX, selling value-added services, and also selling further down market into the client base. So Marika, we've talked about the headwinds and the opportunities. What are the next steps for executives serving the Canadian market?
I certainly think that the first step is identifying the threats and opportunities within the marketplace. Being self-aware of your current strengths and constraints is going to be important before defining a new strategy to act aggressively or defensively within this new environment that we face. I certainly think that risk is going to be a huge focus over the coming year. We've seen some of the Canadian banks retrench from certain areas where they had invested quite a bit, like Latin America and the Caribbean, due to a lot of risk issues there and fraudulent issues going on. So while there are opportunities to expand into into some new markets and move down market, ensuring that the right infrastructure is in place to manage that business effectively is going to be critical.
Yeah, and you notice there the logos of RBC and City National. RBC has purchased City National, and it was intriguing to me that in the press, this was sort of spun as RBC pursuing the private wealth market on a global basis. But for those of you that are not familiar with City National Bank, they are very strong at cash management. For the size of the bank, they're really operating with the sophistication level of a bank, maybe 4 to 5 times its size. So that is actually a pretty powerful gem for RBC if they can leverage that to meet the U.S. needs of their clients. So while it got a lot of notice in the press for the private wealth aspects of it, it brings considerable transaction banking capabilities to what is already one of Canada's most powerful banks.
I think it's also important to understand the dynamics of the new Canadian banking market. As Dave mentioned, there are new client needs. There are new competitors in the market that are going to change the way that we respond, and certainly new regulations that are going to affect the profitability and value of the business that we're in. I think it's also going to mean that getting away from historic lines of business is going to be important. For example, the commodity business, reliance on those types of industries that may be slowing down over the next year or so is going to be critical to maintaining the fee revenue and deposits that are coming in. And finally, taking a step to prioritize the new strategy and investments for 2015 beyond depending on your current state and determining how you want to address these market changes, specifically in relation to your value proposition. So we are certainly happy to help in this new venture in 2015. Treasury Strategies has extensive experience with Canadian banks in defining their deposit strategies, their specific value propositions, pricing and revenue management, target market definition, and optimizing operating models. We also have a 360-degree view of the market with a lot of work done on our corporate side of the business with Canadian firms. So thank you for joining us this morning. If you have additional questions or would like to hear more about how Treasury Strategies can assist you in building out your 2015 strategy, please feel free to reach out to me or Dave, and we're happy to respond to those questions.